Have you ever wondered how you can grow your investments exponentially over time? Do you know about the power of compounding and the Dividend Reinvestment Plan, also known as DRIP? In the world of investing, compounding is a powerful force that works silently in the background, steadily growing your investments. It's like a snowball rolling downhill, gathering more snow and growing bigger with each revolution. In financial terms, compounding is the process where the earnings from an investment are reinvested to earn even more profits. The real magic of compounding comes into play over time as these reinvested earnings start generating their own earnings. Now imagine if you could supercharge compounding effect. That's where the Dividend Reinvestment Plan, or DRIP, comes into the picture. DRIP is an investment tool that takes the concept of compounding to the next level. It allows investors to automatically reinvest their dividends into additional shares. This can often be done without paying any commissions or even at a discounted price, which means you're buying more shares with your dividends, thereby increasing your holdings. The beauty of DRIP lies in its simplicity and the compounding effect it enhances. When you reinvest your dividends, you're essentially earning your dividends. This means that over time, your investment can grow significantly more than you were to take the dividends as cash. Moreover, DRIP offers a disciplined and consistent investment approach. Regardless market conditions, your dividends are automatically reinvested, which can particularly beneficial during market downturns when share prices are low. This disciplined approach, coupled with the power of compounding, can lead to substantial growth in your investment over time. But how do you maximize the benefits of DRIP? It starts with choosing the right stocks, preferably those a history of stable and increasing dividends. Regular monitoring and adjusting of your investment portfolio can also ensure alignment with your financial goals and market conditions. Stay tuned as we delve into the world of DRIP, a tool that can supercharge your investment growth. The Dividend Reinvestment Plan, or DRIP, is a tool that many successful investors swear by. But what exactly is it? Well, imagine sowing a handful of seeds in a fertile field. As the seeds grow into healthy plants, they produce more seeds. Instead of taking these seeds away, you decide to sow them back into the ground. Over time, this cycle of growth and reinvestment creates a lush, thriving field. That's the basic idea behind DRIP. DRIP is an investment strategy that allows you to take the dividends you earn from a company's stock and reinvest those dividends back into purchasing more of that company's stock. This often happens automatically, hence the name Dividend Reinvestment Plan. Let's break it down a little further. When you own shares in a company, you're essentially a part owner of that company. As a part owner, you're entitled to a share of the company's profits, which are often distributed as dividends. Typically, these dividends are paid out in cash. But with a DRIP, instead of receiving cash, your dividends are used to buy more shares or fractions of shares in the company. Now you might be wondering, why would I want more shares instead of cash? That's a great question, and the answer lies in the power of compounding. Compounding is the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. It's like a snowball rolling down a hill, gaining more snow and getting larger the longer it rolls. In the context of DRIP, compounding happens when the dividends from your increased shareholdings are used to buy even more shares. This means that with each dividend payment, you own a slightly larger piece of the company. And because you own a larger piece, you receive larger dividend payments, which are then used to buy even more shares. Over time, this cycle can significantly increase the value of your investment. One of the best things about DRIP is that it often happens automatically, and can sometimes even be commission-free. This means you don't have to worry about timing the market or paying brokerage fees each time you reinvest your dividends. It's a hands-off, cost-effective way to grow your investment. The key to maximizing the benefits of DRIP is choosing the right stocks. Ideally, you want to invest in companies with a history of stable and increasing dividends. These are often established, financially healthy companies that are likely to continue paying dividends in the future. Regular monitoring and adjusting of your investment portfolio are also important to ensure alignment with your financial goals and market conditions. To sum it up, DRIP is an automatic, consistent, and cost-effective way to grow your investment over time. It leverages the power of compounding to turn small, regular investments into a significantly larger sum. It's like planting a seed and watching it grow into a lush, thriving field. In essence, DRIP is a tool for automatic, consistent investment growth. Now that we understand what DRIP is, what are the benefits of using this investment tool? Well, let's dive right in. Firstly, the key advantage of DRIP lies in the automatic reinvestment of dividends into additional shares. Think about it as a self-propelling rocket. Every dividend you receive from your investment is used to buy more shares, which in turn generate more dividends, and those dividends buy even more shares. It's a cycle of growth that keeps building on itself. What's more, these additional shares are often bought at a discounted price or without brokerage fees. This is a huge plus because brokerage fees can eat into your returns over time. With DRIP, you're skipping the middleman and directly reinvesting your dividends. This way, you're getting more bang for your buck, and who doesn't love a good deal? Now let's move on to the second benefit, the compounding effect. This might be the most powerful aspect of DRIP. Compounding is the snowball effect where your earnings generate even more earnings. You're not just making money on your initial investment, but also on the returns that your investment has already paid out. It's growth on growth, and it's how small, consistent investments can grow significantly over time. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and larger. The same principle applies here. Your dividends, once reinvested, become part of your investment, and they too start generating dividends. Over time, this can lead to a sizable increase in the value of your investment, even if the share price doesn't move much. The third benefit is that DRIP can enhance the growth potential of your investment. By constantly reinvesting your dividends, you're increasing your shareholdings. More shares equal more dividends, and more dividends mean more shares. It's a virtuous cycle that can lead to substantial growth over time. This is especially true for long-term investors. If you're in it for the long haul, DRIP can be a powerful tool to build your wealth. It's like planting a tree. You water it, nurture it, and over time, it grows into a mighty oak. Similarly, with DRIP, you're nurturing your investment, and over time it can grow into a substantial nest egg. Finally, it's worth noting that DRIP is a passive strategy. Once you've set it up, it runs on autopilot. You don't need to constantly watch the market or worry about timing your trades. This can be a big relief, especially for those who prefer a hands-off approach to investing. In conclusion, DRIP offers a range of benefits, including automatic reinvestment, the compounding effect, and enhanced growth potential. It's a strategy that rewards patience and consistency, making it a great tool for long-term investors. Clearly, DRIP offers significant advantages for the patient investor. So how can you maximize the benefits of DRIP? This is a question that every savvy investor asks. The first step is to choose the right stocks. Not all stocks are created equal, and it's crucial to opt for those with a history of stable and increasing dividends. Think about dividend aristocrats or kings. These are companies that have consistently increased their dividends over the years, demonstrating financial stability and a commitment to returning capital to shareholders. The increased dividends can then be reinvested to acquire more shares, thus amplifying the power of DRIP. Next, it's essential to regularly monitor and adjust your investment portfolio. The financial markets are dynamic, and it's important to stay on top of changes that could impact your investments. Perhaps a company you've invested in has started to struggle financially, or maybe another company has begun offering more attractive dividends. These are scenarios that may require you to adjust your portfolio to ensure you're maximizing the benefits of DRIP. Regular monitoring will also help you identify when to reinvest your dividends and when to take them as cash, depending on your financial goals and market conditions. Finally, diversification is key to maximizing DRIP benefits. While it can be tempting to put all your eggs in one basket, especially if a particular stock is performing well, it's generally not a good idea. A diversified portfolio spread across different sectors and geographic regions can help mitigate risks and enhance portfolio stability. This way, even if one stock performs poorly, others in your portfolio can offset the loss. Remember, DRIP is not a get-rich-quick scheme. It's a long-term strategy that requires patience and discipline. But with the right approach, choosing the right stocks, regularly monitoring and adjusting your portfolio, and diversifying your investments, you can harness the power of DRIP to grow your wealth steadily over time. With the right approach, DRIP can be a potent tool in your investment arsenal. Let's now look at how DRIP can add substantial value to an investment over time. Imagine you're an investor who purchases 100 shares of a company, let's call it Company A, at $10 per share. That's an initial investment of $1,000. Company A has a dividend yield of 5%, which means they pay out 50 cents per share annually in dividends. At the end of the year, you'd receive $50 in dividends. Now, if you were to take that cash and spend it, your investment remains the same. But if you were to reinvest those dividends through a DRIP, you'd be buying 5 additional shares of Company A without incurring any brokerage fees. That's the beauty of DRIP. It allows you to grow your investment automatically. So, at the start of the second year, you now own 105 shares. If Company A continues to pay the same dividend yield, you'd receive $52.50 in dividends at the end of the second year. And again, if you reinvest those dividends through DRIP, you'd be able to purchase 5 more shares. This process continues year after year, with your number of shares and the amount of dividends you receive both increasing. That's the power of compounding in action. Over a long period, say 25 years, this can lead to a significant increase in the value of your investment. Let's compare this with an investor who chooses not to reinvest their dividends. They would still own the same 100 shares at the end of 25 years, and their investment value would only increase if the price per share increases. On the other hand, the investor who uses DRIP would own more than 300 shares at the end of 25 years, even if the price per share remains constant. That's 3 times the initial investment, all thanks to the power of compounding and DRIP. But remember, the key to maximizing the benefits of DRIP is choosing the right stocks. Look for companies with a history of stable and increasing dividends. Companies that are dividend aristocrats or kings can be a good place to start. Keep in mind that regular monitoring and adjusting of your portfolio are necessary to ensure alignment with your financial goals and market conditions. Diversification is also recommended to mitigate risks and enhance portfolio stability. DRIP is a powerful tool that can significantly enhance your investment growth. It's like a snowball rolling down a hill, gaining more and more mass as it goes. The longer the hill, the bigger the snowball gets. Similarly, the longer you stay invested in a DRIP, the larger your investment grows. As you can see, the power of DRIP is truly remarkable. We've covered a lot of ground today, discussing the power of compounding and the dividend reinvestment plan. It's time to bring it all together, to highlight the key takeaways, and to give you a clear picture of how DRIP can be a game changer for your investment strategy. We started by unveiling the magic of compounding, the process of generating earnings on an asset's reinvested earnings. This principle is the driving force behind DRIP, providing a foundation for exponential growth over time. Then we dove deep into the world of DRIP, an investment tool that allows you to automatically reinvest dividends into more shares. Often without paying any commissions, this strategy enables you to steadily increase your shareholdings and thus your potential future dividends. We explored the notable benefits of DRIP, such as automatic reinvestment, the compounding effect, and the potential to buy additional shares at a discounted price. These advantages combined can supercharge your investment growth and wealth accumulation, particularly over a long-term horizon. Next, we delved into how to maximize the benefits of DRIP. We stressed the importance of choosing the right stocks, those with a history of stable and increasing dividends. We discussed the need for regular monitoring and adjusting of your investment portfolio to align with your financial goals and market conditions. Diversification was also recommended to mitigate risks and enhance portfolio stability. To bring the concept of DRIP to life, we presented a detailed example showing how using DRIP with certain stocks can add substantial value to an investment over time. This illustrated the stark contrast between reinvesting dividends and not doing so, showcasing the potential long-term benefits of engaging in a DRIP strategy. Remember, with patience and the right tools like DRIP, you can grow your investment significantly over time. Thank you for watching and happy investing. Please leave a comment below and don't forget to subscribe for more investment tips.